If I walked into a financial advisor's office today, what do you think that they would recommend, saving or investing? Well, you don't need to wonder, because today we're going to break down this ultimate financial dilemma. Should you save your money or invest it for the future? I will straight up give you the answer now. You should be doing both. Stick around as we're going to unpack exactly why this is and the occasions that you should be saving or investing. First up, let's start by understanding what saving and investing actually mean. Saving is putting your money into a safe, low-risk financial product like a savings account. Now, the idea here is to preserve your capital. You're not going to lose money, but you're not going to make much either. Investing, on the other hand, is a whole different ballgame. You're putting your money into assets that have the potential for higher returns. Now, we're talking about stocks, bonds, and real estate. But remember, with higher returns comes higher risk. Your investment value, it can go up, but it can also go down, and it's going to be volatile along the way. So how do you get around this? Well, you've got to think long term. Holding assets like index funds or S&P 500 trackers gives you diversified exposure to a large amount of the market. Now, these funds are essentially baskets of stocks in their hundreds or thousands, and they track the top performing companies within that chosen basket. Now, investing like this, according to a recent study by Nutmeg, has meant that you would have a 0% chance of losing your money if you invested in a global stock market index fund for over 15 years. 0%. That's pretty good. The key difference, though, between the two does actually boil down to risk and reward. With the savings, you're going to be taking minimal risk, your money is safe, the returns are going to be modest. With investing, you're taking on more risk, but the potential for reward is significantly higher. But as you can see, that when you go back to that Nutmeg thing, the risk over 15 years is near zero. Now, I want to have a little look at this chart that was created by Schroders. Over a 20-year period, stocks will outperform savings 100% of the time. This is any 20-year period since the stock market's inception. Sure, in the near term, those numbers are going to be a lot closer together, but that's why we separate our savings goals. Now, look, as it goes up, we increase up to 20 years. These returns on stocks are 100% better than cash or savings. So I can hear you say, Sammy, well, what about recently? Stocks have underperformed and some of the banks are offering 4 or 5% interest rates. So why don't I just do that and I'll be safe? Well, you wouldn't be wrong, but to explain it, it's because we're in a high interest rate environment. The Bank of England has been raising rates, meaning your bank will offer you more interest on your savings. But whatever the case is, that number is still under what the inflation rate is, meaning your amount is eroding. Yes, stocks underperformed in 2022, so that would be the year that cash actually performed better. But that is really short term when you look at the overall, and you've got to scan out and think long term here. Now, to give that some context, I want to look at this chart that was created by Vanguard. This shows you the cash versus the FTSE All-World Index, which is the global index fund I was talking about before. And this also has inflation factored in as well. This is 10 grand invested at the start of 1998 up until the end of 2022. When you look at the cash returns, you can see a slow and steady rise. But when you look at the cash returns adjusted for inflation, your money is actually worth less than it was in 1998. That is absolutely staggering. Now, I want you to focus your eyes next on the FTSE All-World Index. Sure, there's going to be points like in 2000, we had the dot-com bubble crash. But as we come out of this and we move into 2009 and beyond, just look at this growth difference. Now, I don't want you to think I'm saying don't save. That is not the case. I'm not saying that. If you put £100 into a savings account today, it's not going to go down. And so having this security is extremely important for those with short-term goals and those who are just looking to stash that money away safely. When you're saving your money is secure, but its value is eroding, and that is just facts. So what we need to do is we need to identify when it's right to save and look at ways that you can outperform inflation over the long term. Savings are literally your financial safety net. Think of it as a financial first aid kit. It's there for emergencies like if you lose your job or your roof gets struck by lightning. It's also useful for things like short-term savings goals, like buying a car or going on holiday. Sure, the money isn't going to grow much, but that's totally fine because that's what you need it for in this case. So let's talk about the difference and why investing is so different to this. To do this, we've got to look at the stock market performance over a period of time. Now, the average over a 50-year period for the S&P 500, which is the largest 500 companies in the US, has an average of 10.5% a year. That's including all of the famous crashes that we've experienced, and yet that still kicks out that number. So here's another chart showing the growth of $1 and how the stock market has performed since the 1870s. You can see there's periods of decline and even stagnation, world wars and all of that jazz, and that's just facts. It's still up and to the right. Companies are going to be growing and innovating all the time, so returns are growing with that. More people on the planet means more purchasing power and more money goes into the economy, meaning the stock market returns increase. That's just basic business 101. So what do I do myself? Well, I separate out my savings goals. So for example, right now me and my partner, we're putting money away for when we can actually finally move house. We want this money to be safe no matter what happens in the economy, interest rates and all that jazz, so it's tucked neatly away inside a high interest savings account, which I'm getting about 4.5% on at the moment. Now I'm totally fine with that because I'm not taking risk on that money no matter what. I don't want it to decrease, I don't want to invest it, so we just keep adding a small portion of our income to it each month. Now should the Bank of Interest finally lower their rates, then my interest rate will come down, and that's totally fine with me, but I'll see the gains back in my mortgage rates. So what do I do with everything else? So anything else that's 5 years out or more goes straight into my stocks and shares ISA, and that gets invested. Now, for those of you who don't know, you get £20,000 worth of contribution to your ISA each tax year, and that includes cash ISAs too, which are essentially tax beneficial savings account. In the UK, if you earn £1,000 outside of the ISA environment from a standard savings account in interest, it's called your personal savings allowance. This then makes it subject to income tax. And if you're a higher rate taxpayer with over 10 grand, that's kicking out 5%, it's going to be a little bit of an issue here. But only 11% of us actually max out our ISA each year, so utilize them correctly. Make use of the cash ISAs, the stocks and shares ISAs, because the returns and interest are not subject to any capital gains tax. So there we have it. If your goal is to build wealth or even retire early, history tells us put your money into a savings account isn't going to be the way to go. You need to invest it to build generational wealth and even just literally beat inflation over the long term. Yes, there's going to be risks. Yes, your money can go down if you invest, but these are the elements that we're playing with, and time is on your side if you look at the history book. Now, I hope it's been useful for you, and I really do appreciate it if you could like and subscribe to help us create more content like this. We also have a weekly podcast called the Money Gains Podcast that you can tune into right away. There's a back catalogue of episodes focusing on things like investing, side hustling, saving, budgeting, all of that jazz. So thank you for listening, and we'll see you soon. Cheers.